Hey everybody, welcome to our webinar tonight, and we're going to be talking about a topic that is incredibly exciting and boring probably all at the same time, which is your K1 and your capital account in a real estate syndication specifically. So I think tonight we've got something really neat to talk about because we have a live deal that Spartan Investment Group actually did last year, and we're going to go through the highlights of the 1065 and the K1 and talk about what that means to a specific investor. So we're very honored and fortunate to have Toby Mathis here tonight, who's an attorney and one of the founders at Anderson Advisors. Toby, how you doing?
I'm doing fantastic. Thanks for having me.
You're welcome. Thanks for joining us. Real quick, could you give a little background about yourself and just kind of what you've done for Anderson and what you've done throughout your career and kind of what you're up to today?
Yeah, was one of the founders of Anderson back in the late 90s. I'm a tax attorney by trade, although I don't believe you learn to do something by reading about it in books. I'm an active real estate investor. My partner and I have Clint, who's also one of the founders of Anderson. We've been buying real estate together since we started the company. We have a little over 150 separate single-family residences across the country, several commercial buildings, including warehouse, some office buildings, things like that. Small stuff, not big skyscrapers. Yeah, we just believe that you kind of, the more that you're in it, the more that you learn it from a different perspective, and the more you're able to explain it to others, or the better you're able to explain it to others.
No, that's great. And we just got to spend some quality time together in Maui at the Anderson Advisors Executive Retreat, which was an absolute blast. Thanks for having us out for that. That was a lot of fun.
Isn't it a good group? They're just kind of
It's a
fun
great,
to hang out with, and everybody, you know, there's no bad people there. Everybody's we
yeah,
let them out. We don't let you in unless you're really an investor. So,
yeah. I was sitting down for dinner, and I think the person sitting next to me had like 4,000 units, and I was like, okay, that's a good group of people. So
yeah.
another self-storage guy there too, and just a really good crowd. The other thing I wanted to point out is I just recently learned that Toby does Tax Tuesdays. Is that what it called? Every Tuesday you do like a
Open.
Q&A?
It's
Yeah,
every other Tuesday, so I think we're off this week, and then the 26th I think is the next one. But every other Tuesday we open up. We do a It's kind of interesting. We do it as a go-to webinar. It's kind of similar format as this. But we come out and people email in questions during the 2 weeks. We grab them and we answer them, and then we answer any questions people have live. They're supposed to be an hour, but they always end up being an hour and a half, 2 hours. We record
nice.
them. Yeah, we record them, put them on our site. So like anybody ever wants them, you can go to our podcast and listen to them. But they're, so if you want to get free tax advice, that's where you go. It's just
Nice.
you're sharing it with the world.
Well, thank you so much for doing that. And obviously, if you guys are looking for a tax strategist or professional, you'll find that Toby is one of the best. So without further ado, we'll go ahead and jump into tonight. So the reason why I wanted to have this webinar tonight is, my job as Chief Investment Officer at Spartan Investment Group. I talk to hundreds of investors on a regular basis about what the investment is, what it isn't, and then specifically how it might impact their tax returns. So we syndicate real estate for commercial projects, primarily RV parks and self-storage. And we always do a cost segregation study and bonus depreciation under the new tax law. And so I think it's important for an investor to understand if they're doing a flip or if they're doing a long-term hold, how that impacts their total return. Because as we all talk about as real estate investors, it's not how much you earn, it's how much you keep. So
Mm.
that's what we're going to really kind of get into tonight. And Toby is an attorney, but tonight we're not offering advice. So, seek your outside counsel. This is just a general overview. Seek your own advice. Information contained is subject to change, and obviously perform your own due diligence. So with that disclaimer out of the way, I wanted to point out just real quick before we start, we do webinars every month in 2019. And tonight we're doing the bottom one, which is understanding your K1 and capital account. And we actually had Toby's partner, Clint Coons from Anderson Advisor, on a deep dive into self-directed retirement accounts. earlier this year, and we've also had syndication attorneys come on our webinars and talk about private placement memorandums, operating agreements. We've had Russell Gray from the Real Estate Guys Radio. We've had Kathy Fetke from Real Wealth Network. We've had some really, really great guests. And all of our webinars can be replayed by going to our YouTube channel, Spartan Investment Group, on YouTube, and you can replay all those webinars. So just a little bit about kind of what we're talking about tonight. So we typically do a equity and debt stack. So we raise private equity from individual investors who have ownership interest in the project, or sometimes we do debt structures where they're secured by a lien. And the property that we're talking about tonight, we had $1 million of equity raised for the project and $1 million of debt. Both sources came from individual investors. Investing is a minimum of 50K at a time. And we're going to go ahead and jump into that. So Toby, what is a K1 and why should we care? And dump all of your awesome knowledge on us about K1s in general.
Yeah, I can certainly do that. A K1 is, at its simplest, it's just your share of whatever money was made, whatever deductions are given, any credits, any losses. Basically, the easiest way to think of these is it's for a non-taxpayer entity that is passing down all of its income and whether it be profit or losses down to its owners. So you're going to get a K1, generally speaking, the ones you're going to be most familiar with is for partnerships. And so there's a U.S. return of partnership income, which is a 1065, which if you're in real estate, that first page always says 0 on it. You're always going to look at it and go, hey, because it doesn't sit there and generate ordinary business income. It's rarely. And then it's going to pass down whatever is contained in that return to its various partners. And so that's where you get that K1. And it's going to basically keep track of the big important things are that it keeps track of is how much money is made and what kind of capital account you're keeping as a partner. You as a partner, this is actually really important and maybe beyond what you necessarily want to go on today, but every partner has an outside basis and every partnership has an inside basis. And you could do this for a S corporation as well. They also give out K1s. But your outside basis is what you're kind of on the hook for and how much you put in to the partnership. And then the inside basis is the fair market value of those assets after they're transferred. So, I guess the prime example is if I transfer in property that I have a low basis in, and the partnership, I have an outside basis which is much lower. The partnership has a much higher basis as to what it can return to me. Like it may have a fair market value basis of 40 grand if I contributed a piece of property that I only have $10,000 basis in. In other words, it doesn't magically step up for me. And it's kind of a hard concept for people to get their heads around, and even harder it seems for accountants to get their head around. The most obvious thing is if I give it cash, my basis is exactly the same because the fair market value of that cash when I put it in is the exact same. So people tend to like to raise cash because it's so easy to track basis. But when a lot of people put properties in, they've owned it for a little while, their basis isn't exactly what they put in at. They have an outside basis that could be lower than the basis that the partnership received. Throws people off a little bit. And I know that's going to come up for you guys when you start talking about receiving cash in excess of your basis, which I imagine we'll be talking about a little bit later.
Absolutely. Yeah. And I think, the big takeaway that we always kind of, say is, in respect to our investors, we try to get these K1s out no later than the end of February because, like you said, this is something that informs your personal tax return on what taxes that you have to pay, or what losses or gains that you have. So if you don't have this K1 by the end of February, you're really kind of waiting to do your tax return, right? I mean, isn't that kind of the,
Yeah.
I'm sure
So let me go over this with you just because you guys might be different. Most people are shooting to get the partnership return out for the end of February, but almost nobody does. And there's lots of groups that don't get it out until probably in the middle of summer. And the reason being is there's an automatic extension given for partnership returns. So you're sitting around waiting for your K1 so you can file your return, but you also have a 6-month extension that's an automatic extension. So really your tax deadline for an individual is October 15th, and the tax deadline for a partnership is September 15th. You have to pay your taxes for the previous year on April 15th, or you'll incur penalties and interest. And so those are all different little pieces. So a lot of partnerships don't kick out their K1s till their final K1s. They may do a preliminary return to help everybody estimate what their tax liability is going to be, so they can make sure they're paid in April. But a lot of them don't put out their final return until August, so that so that they can make sure that their return is done by September 15th, the partnership return, and that gives their partners, the people that invested, about a month to make sure that they get their personal tax return completed. So like, you guys are way ahead of the curve if you're making sure you're getting it out by February. I just know that my experience is most partnerships shoot for that, but they rarely get the final return out by then.
Gotcha. Yeah, that does make, yeah, I mean, you're right. It is kind of it's a chore to get it out by the end of February, but we like to at least do all the subsidiary partnerships by then, just so that,
Yeah,
if you want to file
absolutely.
on time. Yeah. And
No, that's
it's a
about
lot of work. It's a lot of work because you got to slam the books closed and, reconcile and get everything over to your CPA. Then your CPA has to do a good job in getting that all done. So, hats off to Hunt Jackson for doing those returns for us.
mm-hmm.
Um, yeah, so okay, so basically, we're going to do a case study tonight. We're going to go over the Goldenrod case study, which is an RV park that we purchased back in March of 2018 last year. And basically, it allowed our investors to do a passive investment into a syndication. The partnership bought an RV park, and we did a cost segregation study, and we used 100% bonus depreciation in year one. And during the first 10 months, as kind of like a small example, if you invested $100,000 in that partnership, you would have received about $8,870 in distributions. So this is kind of a lot of information, just kind of thrown out there for the case study. But basically, if you want to learn about cost segregation studies, you can go listen to our tax tips for real estate investing podcast or webinar that we did with Yona Weiss from Madison Spec and with Mark Canton from Hunt Jackson, where we talked all about what a cost segregation study is and how it works. But basically, it's an engineer that goes out to the property that breaks out the life into 4 buckets: land improvements, building, and building improvements. I think I got that right, Toby.
Kind
And
of.
then you
Close enough.
well, take us away on that. Yeah, why don't you go ahead and just kind of talk to us a little bit about what is a cost segregation study and kind of what goes into that, and how does that sort of translate into our tax return and eventually to our K1.
Oh, this is fun. Cost segregations are awesome. Yeah. So, yeah, I mean, you gave it a good explanation, but I'm going to make it a little more real, just for people that like to look at returns or actually want to know where it's reported. And where you're going to find this on a partnership return is 4562. So it's a form, and it says depreciation and amortization on it, and it'll be inside the partnership return. And what you'll notice is that you're going to have this asset placed in service, and you have all these different criteria. It says MACR's depreciation, so modified accelerated cost recovery system. You just go down and look at it and say, hey, there's all these different types of property. There's 3-year, 5-year, 7-year, 10-year, 15-year, 20-year, 25-year residential rental property, non-residential rental property, and they all have these lifespans. So they'll say their recovery period. You'll notice that on the form, the residential property and the commercial property are etched in stone. So it just says 27.5 years for residential. So, rental property is 27.5 year. And you have 39-year property for non-residential, that's commercial. And so you're breaking those things down, that's the default. If you want to accelerate your depreciation, then you have to do a change of accounting, Form 3115. Generally speaking, you're just breaking this down. Usually it's the individual that's making that election on their return. And they choose, hey, you know what? Instead of taking the default, I would rather have this broken down into 5, 7, 15-year property. When we're talking about real property, those are the only ones we really care about. And you're breaking it down into segments, and that's what you need the engineers to come out and do. And they're saying, like in your case, I could actually look at this as called, I just know it as the RV park. So you said it was, you had a name for it, Goldenrod, I think.
Goldenrod, yep.
Yep. So you can actually see that it broke down its assets into different groupings of property. So 5-year property of 121. Oh, you're probably popping it up there. Yeah. So you can actually see it right there. That's great that you just popped that up. And you could see that the 5-year property is broken out from everything else. So so anybody who does this, any accountant's going to look at that and they're going to know, and this includes the IRS, they're going to say, hey, look, they broke this out into categories 5, 7, and 15-year. Well, what that does is it gives us the opportunity under the Tax Cut and Jobs Act to use something called bonus depreciation. And if you want to get technical, it's 168K of the Internal Revenue Code. You're not going to be able to even see that. But that's just the code section. And what it says is if it's less than 20-year property, you can choose to write it off in year 1. And it used to only be for new property put into service that year. Now it's used property. So for folks that are doing real estate, this has been great. I don't know if it would have made much of a difference for you guys, given that you bought this property, I believe, in 2018. But what it allows you to do, in your case, you took a $759,000 deduction in year 1 on bonus depreciation, and then you broke out each of those 5, 7, 15-year property, and even the 39-year property, and you took ordinary depreciation on those for the portion of the year where, I believe it was probably the portion of the year where you're doing the rehab on it. So
Correct.
you end up with a pretty spectacular deduction when you break these things down in that first year. And that's why people love cost segregating. It's you get a massive benefit. There is a benefit that people don't talk about, and that is that when you break down 5, 7, and 15-year property, though that property, for example, if I had a 5-year property, carpeting might be 5-year property. So if I have carpeting at the end of 5 years, I'll ask you this, Ryan, this will be fun. How much do you think carpet's worth after 5 years?
0.
Yeah. So in the IRS's world, you've only written off, ordinarily, you've written off 5 years out of 39 years of that carpet. And then if you sell the building, they say any gain is allocated partially to that carpeting in the form of what they call dividend, or excuse me, depreciation recapture. So I would have to, anything I wrote off on the carpeting, I'd have to recapture at my ordinary bracket, capped at 25%. And so we just said that it wasn't worth anything after 5 years. So why the heck would you be paying tax on it when you sell that property? So this cost segregation allows that to be treated as it really is, which is if you sold this after 5 years, that would be 0. That makes it all capital gains. And in my world, that just means instead of paying a maximum of 25% of depreciation recapture, I only have to pay a maximum of 20% of long-term capital gains. So it saves me money. A lot of folks think the opposite. It's like they think that the cost segregation is going to hurt them when they sell it, and that's not the case. If you hold it for 5, 7, 8 years, you're going to be far better off. And we've actually done or had cost segregations done for clients right before they sold a property, simply because it took care of that. There was huge capital expenditures, and they said, hey, I don't want to pay depreciation recapture and all this. I want to treat it the way it really is. I want to break that property out. And even if I've depreciated a bunch of it, now at least it's 5-year property that has no value. I don't have to do recapture on it. So it makes a pretty big impact.
Absolutely. And I think That's one really important thing to talk about is, we'll kind of get into the numbers here on how we use that depreciation
Hmm.
in to offset gains in this park. Now, the RV parks are typically high cash flow assets, and
Hmm.
as you can see here in the 8825 form, um,
That's
we
a great form, by the way. That's what you need to be looking. I'm just saying is that
yeah.
that's part of a partnership return. That's where everybody should be going.
Yep. So, just to take a step back here, because, we may have a new person who's never done a syndication on the call or done any real estate investing whatsoever. So I think it's important to kind of note that in a syndication with Spartan, we are doing the tax return. We are doing all the work. We're operating the property. We're buying the property. We're organizing the team to do the tax return. So with us, anytime that anybody wants to see our full tax return to understand everything that happened on a property, that's accessible to you. Now we'll have to redact some information because there's some personal information that is typically buried in within these tax returns, which is what we've got blacked out there.
Hmm.
EIN number, sometimes there's social security numbers on the tax returns. But if you really want to kind of understand how the asset did and was reported to the IRS, you can get this copy from us, and or you can ask your syndicator, or your operator to provide you with this form so you can see how the property did. So in this case, just kind of jumping into this, our gross rents collected was about 702,000 for the 10 or so months that we operated the park. And you can see we broke down all of our expenses: advertising, auto and travel, cleaning and maintenance, commissions, insurance, so on and so forth. But I want to jump down to the first blue arrow, which is depreciation. And you'll see in the first year, we have an $813,000 and or 813 $461 depreciation line, which really helps us wipe out all of our gain. That amounted to a $1.241 million loss. And you can see at the bottom, our net loss on the property in the first year was $538,000, even though the property was profitable. So, Toby, talk us through kind of, how that gets dispersed to the partnership, and in this case, the investor that owned 2% of the project, kind of how that loss sort of translates onto the return, because they're not going to get a full tax return. They're just going to get a K1. Um,
Right. So that line item would be their net rental real estate income. So it'd actually be line two of part three of their K1. So it's going to be on your K1, and it's going to basically, you could either have ordinary business income, like if you were running a regular partnership or running McDonald's, for example, you'd have ordinary income. But this is net rental income. So you're doing the rental, real estate, income, and expenses. So you can actually see it. That's what that form is. That 8825 is what tells the story. And if I look at this, I'm thinking this is a monster cash cow. If somebody looked at it from the outside, a bank may look at it, for example, and say, you lost how much? You lost 538,000 in year one. What the heck? Do you guys even know how to run a business? But somebody who understands returns is actually looking at this going, this thing was making $70,000 a month, and the most of the expense is depreciation. I mean, a good chunk of it. I see about what would it be, about three. You look at interest, you look at the professional fees. Interest was 94,000 by itself, so I know there's some debt there. But you take out that depreciation, you have $400,000 total expenses. We have a net positive cash flow of about 300,000. What do you guys buy that for?
1.74 million.
Jeez Louise.
Yeah, I think it's operating at around, well, in the first year, I think it
Yep.
operated around a 30 or 40% cap rate. So not a bad purchase.
Jeez Louise. Sign me up. Oh my God. I mean, like,
Yeah.
you got to understand, like most institutional people are looking at 7% and 8%. Like they're excited. And here you are posting 30%. That's bananas. But
Yeah, it's been a good, it was a good purchase for
yeah,
sure.
well, but again, most people don't actually go past the first page of a 1065, and most investors only look at their K1. but the
Sure.
story always is told inside on these schedules. It's on your L on your schedule, and your schedule L and your 8825 and your depreciation schedule. Like, in fact, Warren Buffett's famous for being a value investor, where he would just go back in and add in the depreciation. You would just take that, you just literally remove that as an expense and go add it back in when you do your balance sheet into the asset. And so that tells the story. And so somebody who knows what they're doing looks at this and goes, that's a cash cow. And wow, and you didn't have to pay a lot of tax on it in first year. In fact, you're going to be probably not paying much tax on it in the second year either. You're going to have a loss carry forward.
Yeah, so that's actually a good segue. So here's the K1, and uh, you can see that in block two here up by the blue arrow, the
Mhm.
partner who invested, and in this case they invested 100,000 for a 2% stake, they actually got a loss for $10,774. Can
Mhm.
you kind of dive into that a little bit?
Yeah, so they got their 2% of the $538,000 loss. So if you just multiplied 2% by 5, or 0.02, whatever it is, times 538, you're going to get that 10,774. Now, the thing about that 10,000 is it depends on the taxpayer, the recipient, as to whether they have to pay tax on it or not. I mean, excuse me, not whether they're going to pay tax, whether that's going to be a loss that they can take against other income.
Now, can I
So
stop you? Can I stop you right there? Because this is a
yeah.
question that I get like all the time. So this individual is not a real estate professional. He's a
Mhm.
W-2 income earner, high income earner,
Mhm.
and probably in the highest tax bracket. So my understanding is that in this case, they cannot take the losses against their earned income from W-2, but rather they can take their loss against other passive activity. Is that correct?
Correct. There's two types of passive activities. There's businesses in which you do not materially participate, and there's rental real estate. Those are passive activities. So this would offset the those passive activities. So if you have maybe a what is it, an S corp or something, where you're just a passive investor and it makes a little bit of money, this would offset that.
Gotcha.
If you
So,
have, yeah, go ahead.
no, and I was going to say, and so if you go down to block 19, it shows that the investor made $8,870. So that's how
But
much
that's
they were.
different.
Yep.
That's different. That's distributions. So when you say that they made that, they received that as a distribution, but we don't want to confuse that with income. That's non-taxable distribution. That's return of their investment. So, and we'll get into that, I'm sure, when we talk about distributions, but you can have a negative income. So I can get that $10,000 loss. And even though I got $8,870 cash in my pocket, it doesn't affect that $10,000 loss. I still get that $10,774 loss, and I don't lose it. I carry it forward.
Yep. So that's another question that I have. So how much of that carries forward? 100%, or is it a percentage of that?
Yeah, 100% of it. But get
Gotcha.
this right. This is what's gonna make your day, depending on what you guys do with your syndications. So I have I call that a tax appetite. When I have losses carrying forward, then I want to have more profit. And when you're doing a syndication, you usually take those losses in year two, and 1 and 2 and 3. By year 3, we're kicking out a bunch of profit, which is a great time to be going into a new syndication to create the loss to offset the profit of the previous syndication. That's what I see.
Correct.
Now, let's say someone says, you know what? No, I just want to cash out. And so you guys cash out periodically. The rule with passive activity loss, and this is so critical, accountants screw this up all the time, is that when you have business property, even if it's passive, and you liquidate it, those losses release and become active losses. So
Gotcha.
if I have a $10,000 real estate loss that's floating around out there, passive activity loss, and they liquidated out their interest, all things being equal, that $10,000 now becomes an active loss.
Interesting.
Yep. And so we saw this a lot in 2007, 8, and 9, and 10, where people lost. They were carrying around losers, and their accountants were saying, "Oh, it's passive loss. You can't do anything with it." We're looking at them like, "Are you kidding me? Like, if you have other income, get rid of that beast. Drop it." And they're like, "Well, I'm going to lose money on it." And I was like, "Good. That's an active loss. You got rid of your trade or business property. Dump it, and offset your other taxable income. Get yourself to zero if you have to, to make up for the loss you took on the real estate. Now, in your case, you're making money on the real estate, so it's going to offset that gain. But the best thing is when you have passive losses and you're like, oh my goodness, I have a loss. People don't realize that it becomes active when you release it, when you dispose of it. A lot of accountants aren't aware of that. So just put that in the back of your head that if you ever have a loser, don't carry it around because you're afraid of losing the money. You dump it, take the loss, offset other income. If you're in the highest tax bracket, if you're in California, for example, that's 50% on the money. So, if it was this taxpayer, that $10,000 of loss would be worth over $5,000 to them tax wise. So they may say, oh, good, get rid of it. I know that's not the case here, but people should just be aware of it.
Gotcha. So on here, basically to summarize this K1, the investor gets this in the mail by the end of February, hopefully, or sometime during the summertime when the partnership return is done. They can go, okay, I was distributed $8,870 cash in pocket,
Mhm.
and but I'm handed a loss. I mean, that is like magic.
It is
And
magic. That's why people do real estate. This is
right.
exactly why you do it. That one doesn't have to do with the other.
Yeah, so I mean, and I think that's really important to stress because, when you're looking at a stock that's 8% versus a real estate deal that's 8%, and you say, well, why would I do your real estate deal that's 8% versus the stock that's 8%? I think you got to go deeper and you've got to look at
Yeah.
what your losses might be. Now, I know we didn't throw the example up here today, but we used to flip property, we used to build and sell property, and there was a lot of disappointment when the property would sell and it looked like the gain went in block one, which is ordinary business income. Is that usually where it goes? I'm pretty
Yeah,
sure.
because that's
Yeah.
that's a dealer property. You have inventory when you're flipping. You don't have investment real estate. Investment real estate is when you plan to hold it for a long period of time and make the appreciation. It's inventory if you're a dealer. So you're a developer, you're a builder, any of those, that's ordinary income.
Gotcha. And that's going right to the bottom of your taxable income and could be
Yep.
taxed at the highest tax bracket. So,
Oh, not
when
just that, but it's also ordinary. I mean, it could be active. So if this guy's passive, so you're like, hey, I'm a passive member, that's good. But if you're involved in the flip at all, that's subject to self-employment tax too, or old age, death and survivor, and Medicare, Social Security, whatever you want to call it, FICA. It's all the same thing.
Yep, yep. So some of the worst, and which is one of the reasons why we've kind of shifted away from flipping houses and buying or building condos and selling them, because one of the things that's disincentivized is through taxes, tax purposes.
Yeah. Well, this is a
Um,
cash cow. You're gonna like this thing's gonna kick off income. It's always passive. That's
correct.
the beautiful part about rental real estate is that it's never subject like, and this is what's a lot of people don't realize this. When you break down what taxes are collected by our government, it goes income taxes, individual income taxes, then it goes self-employment taxes or Social Security taxes, and then way down is business tax. So by far and away, I think it's about 80% are income taxes, and I think income taxes was 56%, and then the Social Security taxes were close to 36%. It's a huge chunk of tax, and you never have to worry about that with rental income.
That's great. That's why we're doing this business.
Yeah,
So,
well, you're doing it right.
so I think we've answered these questions. Does my $10,000 loss carry over to future years? You answered yes to that.
Well, Ryan, let me hit on two things because there's two
Yeah, sure.
exceptions to the loss not being taken, where you can't take it. You can take that loss if you make, less than really it's a phase out between 100 and 150,000. But if you're in the $100,000 range, you could take up to $25,000 of that loss. So you could take that 10,000 $774 loss, if that taxpayer got their income down to less than 150,000, they can start reaping that benefit. Probably about, I think it would be about, I want to say 125,000. If they were 125,000 and below, they could take that whole amount. And then the
Wow.
other one is if they're a real estate professional. So, and that's 469C7, and that's just it has to be the primary way you make your living is in real estate. It doesn't have to be this real estate, but just real estate in general. Buying and selling, developing, broker, a lot of real estate agents qualify. 750 hours, and then they have to materially participate in their real estate activities. So you'd have to look and see what else they own, make an election to treat it all as one. But in those circumstances, you can actually take that loss against your W-2 income, any salaries you're making, any other income you're making from other businesses. So that loss can become an active loss depending on whose hands it's in when it comes down.
That's great. And I have a typo here. The 50% bonus depreciation. That's we actually did 100% bonus depreciation on this asset, but the new tax code allows you to do 50% in the first year and then spread the remaining useful life over their respective useful life for the rest of the project.
Yep.
So that's kind of a neat little advantage of the new tax code, which is great. We talked about loss recaptured when the property is eventually sold. We talked about the carpet example, so that was good. And then this is kind of in the investor's eyes. Do they need the full 1065 to complete their tax return or just the K1?
They should be able to get by with just the K1. I'll tell you what we've seen is accountants are really bad about keeping track of your outside basis. So remember I said that there was two types of basis. There's the basis
right.
inside and there's the basis outside. Whether or not the money you receive in your hand is taxable depends on that outside basis. So way up above, you said, is my 8870, but that $8,870 distribution taxable? No, as long as it's return of your investment. You go above that, then the question is, what's your basis? And so if you're on the hook on the loans, you'll see that on a K1, it's actually the partner share of liabilities, section K on your K1. It'll say whether or not you are recourse, non-recourse, or qualified non-recourse. And if it's recourse, now you have basis. And so you could receive up to that amount as in like literally you could receive a whole bunch of cash without actually having to, I put 50 in and I could receive 100 out and not pay any tax on it if I'm on the hook for the loans on the property. So it's where you see a lot of people buy property, take that, their real estate professionals like to take that bonus depreciation. They'll refi the property, take a bunch of cash out and go do it again the next year. What they're doing is, that's exactly what they're doing, is they're looking at it saying, hey, I can get a big fat tax loss and I'll just keep going and doing it. I don't ever have to pay the piper on those properties. I just keep those properties.
Oh, that's great.
Mm-hmm.
Now, I know we talked about this before the webinar, but we're going to bust this topic wide open. And I think this is probably one of the questions that a lot of people aren't asking or they don't want the answer to. But if I invested with my IRA or 401k, where is the UDFI or the UBTI reported? So I got this question recently from my self-directed retirement account, one of our administrators that we use. They asked us, hey, where do you guys report that? And I didn't have a great answer for them because it's not in the K1 and it's not in the 1065, or is it?
It kind of is, but you actually have to look at the 1065 and you're going to go to L. You're going to go to Schedule L because it's saying what it's going to give you the balance sheet to see if there's debt. And for UDFI, it's a little bit of a different animal. You're going to have to figure out what type of income you're getting and whether you're in a regular trade or business. It's really tough to have the UBTI, unrelated business taxable income. It's really hard to have that when you're a limited partner or you're sitting back as a passive investor. That's when an exempt organization is doing business. So like if you ran a McDonald's out of your exempt organization, you're no longer exempt. It's going to pay tax at either the trust rates or your rate. If a IRA invests in a company like McDonald's, the publicly traded company, then it's not going to be treated as UBTI. So it's kind of like, what is the actual exempt organization doing? So I don't think UBTI is even an issue for you guys. It's the UDFI, which is unrelated debt financed income, that is going to be an issue only for your IRA holders. 401ks are not subject to UDFI. IRAs are. And the easiest way to explain this, and that goes for for example, you showed me I think it was an RV park that was flipped. Was that? No, maybe that's a
No,
different.
that's actually, we built 4 condos in Washington, D.C. last year, or we sold them last year. We built them over the last couple of years,
Yep.
and we sold them as inventory. So the worst taxes you can pay on an asset, because we never actually entered them into service as
Hmm.
rentals. They were just built and sold as condos. So kind of the worst taxes you could pay. That was the other example that I sent you, but the RV park is a buy and hold. So it's
Well, so the one that you sent where they flipped it, so that would be the DC properties.
yes,
Uh, that one had debt, and it was partnered, or I think it was no, it was a small amount of debt that was probably done to help acquire and rehab the property, maybe.
correct. Yeah, it was it
And
was, it was a construction loan. Yep.
perfect. Okay, so that construction loan, if you had an IRA investor, then they would have had to have done what's called a 990T and reported a portion of the income as taxable. And it is such a bizarre way you do it. You actually average out the debt versus the income, and you're not really going to see it anywhere. Oh, there's the 990T. I threw it up there. So you're going to see it's actually under the, I think it was 4A, capital gain net income. Yeah, I think that's it, where that one ends up going. And then that's, excuse me, that would be, yeah, on the flip, that would actually be at 4A. Sorry, the forms aren't the most straightforward. If it's a rental property and I keep the property, then it's going down more than likely on 7, unrelated debt finance income. And all you're doing is you're figuring out what portion of the income is attributable to debt. And then whatever portion of that income that was attributed to me being being attributable to debt, that's what I have to pay tax on. And it's up to you. It's not your, I shouldn't say you, it's up to the IRA company, the custodian, to file the 990T. And I'll just tell you this, most don't. Most people
Yeah.
have no idea that they even owe it until they get audited. And then they're like, what? Why didn't they
Yep.
tell me to do this? And the custodian say, well, we don't give advice. And, and then they look at you and you're like, that's not even what we give. Like you would have to, they would have to ask you for the information so they could actually do the calculation to figure out what it was what the debt was when you incurred it, how long, and what's the average amount over that period, and how much income was actually attributed to it.
That's correct. Yep. And that's
So
why that's probably why they are asking. But let's jump back to capital accounts.
I'll
I
make
guess
it
we're,
simple. I'll make it
yeah,
simple, Ryan. Don't invest through your IRA. Just roll it into a 401k. Set
that's
up a
right. Yeah.
401k, and then it's a non-issue. There, made it easy.
Yeah, and I do want to address that though, because some people don't have self-employment income and they couldn't contribute. Con,
Doesn't matter. You can.
exactly. Yeah, I was gonna. Yeah, go ahead. Sorry, I was gonna say I think probably what you're gonna say next.
No, you say it. It sounds better from you.
No, it's all good. Yeah, what we encourage a lot of people to do is and again, we don't offer advice or anything, so check with your outside counsel, like folks like Anderson Advisors. But we once instead of doing an SDIRA necessarily, do a solo 401k. You put the money into a solo 401k, and then you say, well, I can't contribute to the solo 401k because I don't have self-employment income. I don't have 1099 income to continue contributing to it. But after you set it up, my understanding is that you could contribute to an IRA and you could convert those funds into your solo 401k later. And by doing that, you get the benefit of not paying any UDFI tax or having to be subject to any of this stuff. Did I say that
Yep.
right?
You said it perfect. In fact, the one part that people don't realize is when you're with a self-directed IRA company, everything has to be done through your custodian. When you are your own 401k, you don't need a custodian. You can be your
That's
own
right.
yeah. And so and in investments, you can set up it either. You don't have to set up an entity, but it's usually best to set up a little entity to sponsor. It can hold your interest in your rental properties. So if you're doing a bunch of syndications, you can just set up an LLC that holds all your syndication holdings. That's what you invest through. It's
Sure.
a nice little buffer. Keeps people
Yeah.
from taking it from you.
And it's probably worth saying a lot of our clients, a lot of our investors go through WealthFlex, and it's actually a trust agreement that's set up. So it's not a custod. They're not acting as the custodian. They're actually acting as an administrator of your retirement plan.
Oh, so they're just charging you an annual
Yeah,
fee, probably.
that's
Yeah. Okay.
right.
I've
Yeah,
had, you know what, I've heard of them twice in the last month or so, and from people that actually seem pretty happy with them. So that would be an opportunity. Like they do a 401k.
that's right.
So I would set it up through that. And they said that they're pretty cheap from it when it comes to the cost of maintaining it.
That's right. Yeah, and then it's set up as a trust, so it lands in a checking account, revocable trust checking account that you set up, and then you can act on it whenever. There's no need to go through an LLC, or there's no need to go through a custodian on a transaction by transaction basis. But anyway, we're probably a little bit off topic of that. I want to talk about capital accounts.
Hmm.
Um, let's see what we had up here. Oh, and this is the balance sheet. Oh, shoot, you put the Schedule L up here so nicely. Real quick, jumping back to talking about understanding UDFI and understanding the balance sheet. This is in the 1065, right? The Schedule L.
Yeah, I'm going to be looking at the Schedule L, and I'm going to look at the beginning of the year, there was no debt. At the end of the year, there was a million, which realistically is, there's only 1 year, so it's the $1 million. But I see there's $1 million of debt. So the the good news is you ran at a loss, so it's a moot point.
Right.
It's only
Yep.
if you have income. So like the fact that you made it a loss is to anybody who has an IRA, now they can start breathing again.
Yep.
Um, yeah.
No, no IRAs. I usually try to talk to my investors about, people ask, should we do an IRA with this one or should we do cash or what have you? And, we had a property we bought earlier this year in Fort Worth, a storage, and we didn't take any debt on the property. And
Mhm.
so that one was actually perfect for an IRA.
Yeah.
Whereas, this one, obviously, with cash, there's a lot of benefits to doing it in cash because it's, there's huge tax losses and
Yeah.
great cash flow. So it just depends kind of like what cash you have available and what buckets of money and things like that. So,
That's
but
perfect.
to answer the question, if people want to know how much UDFI or kind of to talk to their financial strategist or tax planner, the Schedule L and the 1065 looks something like this, and this is kind of where you can glean some information about UDFI and things like that. So,
Yep.
all right, capital account basics. Um, just to kind of jump back, this is your capital account on your K1 down here,
Hmm.
two blue arrows. So if you want to know what your capital account is, and this confused the heck out of me the first time I saw it a few years ago. So $100,000 is invested, uh, $10,000 loss, 8,800 distribution, but now my ending capital account is less than what I started. Can you kind
Hmm.
of walk us through the semantics of that? That really confused me. Why is my capital account getting smaller?
Well, so you have to like take your capital account and understand what it is. That just means equity. That means what I own in that partnership. So people always want to tie their capital account directly to what it's making, and those are two things. So you have the easiest way to look at it is there's part one, information about the partnership, part two, information about the partner. That's where this says, hey, let me tell you about this partner. This is what their equity in our company is. And then part three is the partner's share of current year income, deductions, credits, and other items. That's where it says, hey, this is what we made this year. So that the information about the partner is an ongoing, forever type of thing. It's not, has nothing to do with the income or whatever that current year is doing. So the way that you look at a capital account, it's your equity. So if I put $100,000 in a company and nothing happens, it makes zero, it doesn't pay me anything, my capital account at the end of the year is going to be 100,000. That's still what I have in there. It's just sitting in cash. Now, if I put $100,000 in and I lose $10,000 operating my business, well, my equity just went down. That loss lowers my capital account. I have a $10,000 loss. So if I had 100 and I lost 10, I would have about a $90,000 equity account. And if I took an additional $10,000 out because I needed money, I said, hey, distribute $10,000 out for whatever reason, that lowers my capital account even that much further. So I would go 100,000 minus 10 would be about 80,000. So I kind of mirrored what you guys did because it has nothing to do with really the cash that's in the company or the assets that are in the company. It has everything to do with, you know, the profits and the losses that get distributed out and how much money I take out. So like, let's say I did $100,000 and I made $10,000, that would increase my capital account by 10,000. And let's say I didn't take anything out, then my ending capital account would be 110,000. So, you know, I'm
Got
just
it.
trying to go through it. I give some examples, by the way, if you go through those slides, I actually walk them through it.
Yep. Okay, so example, John contributes $25,000 to ABC partnership. ABC makes 100 grand in the first year. John is a 10% partner. John's account looks like this: $25,000 initial capital contribution, $10,000 profit allocation, and the ending capital account is 35,000 bucks. So pretty simple example.
Mm-hmm. We
Excellent.
like that. That's easy. So all you look at it, actually right above that's if you just grab that and put it in front of anybody that ever invests in a partnership, it'd probably make their life a lot easier. Whatever I put plus any profits makes my capital account go up. Anything I take out, if I sell it to somebody else or if I have losses, makes it go down. That's the easiest thing.
Yep, makes sense. Oh, here's another example.
Mm-hmm.
Let's run through this. John contributes $25,000 to the partnership. ABC makes $100,000 per year. John is a 10% partner. John receives a distribution of $50,000, and John's account looks like this: $25,000 initial capital contribution, plus a $10,000 profit allocation, minus a $50,000 distribution. So the ending capital account is $15,000, or minus $15,000. Makes sense?
Mm-hmm. So what are the taxes on this? This is where it gets fun. Well, we know that they made profit, so that means that the profit allocation would show up on his K1 as line 1, more than like if it's ordinary, or line 2 if it's rents. And then that distribution shows up, and the question is, hey, any distributions in excess of your basis is taxable as long-term capital gains. So your basis becomes really important. And guess what most partnerships and their accountants never do? Track basis. So it's really up to the individual investor. Like you'll track what they put into it, but you don't know their outside basis. You probably know yours. Like if you sign on to debt, your accountant's going to say, hey, you're on the hook for these loans. It's listed there as recourse liability. You could receive up to that amount and never have to worry about, you know, when I say receive, you could receive distributions up to that amount that exceed your capital account. So if I have a capital account of 100,000 and I'm on the hook for $1 million loan, I could receive $1.1 million back tax free out of
That's
that. I could,
great.
yeah. So that's a lot of individuals do that stuff, but that same thing holds true for being an investor in a partnership. If you receive more money, so let's say you guys pulled a whole bunch of cash out of this big cash cow you have. So you have this RV park that's worth at a 30 cap, let's say at a 20 cap. Holy
We had
Jiminy.
it recently, so we bought it for 1.74 and it just appraised for 5.5 million.
Okay, let's say that you took 5 million out and you gave everybody a chunk of money. Wow, that's a lot of money. So you
It
give,
is.
yeah, so let's just say you gave everybody back a big chunk of money. The person that has a capital account of 100,000, let's say you gave them 500,000, if without even getting into profit, like this thing ran at a loss, right? So they would get their $100,000 back tax free, and then they would receive another 400,000. That is, if they don't have basis, in other words, they're not on the hook, that just means it's long-term capital gains. So that extra 400,000, it's not, horrific. It's going to be depending on what their tax return or what their tax bracket is. More than likely, they're going to be at 20%. But depending on their tax bracket, some of that could be, a lot less.
Sure.
So, especially if they have other real estate losses. So I hope you're seeing how all these things tie in together. If I could create a loss for somebody, a lot of that capital gain wouldn't even be taxable. If I can create a big loss for somebody, then it would be at zero, because your long-term capital gains rates can be zero. If your taxable income, if you're married filing jointly, for example, if you're below 78,000, your long-term capital gains is zero. So it ends up, hey, maybe I can get some of this money out and borrow it out, and if I'm not on the hook for it, maybe I can still get some of that cash out and I don't have to pay tax on it. It's up to the individual taxpayer that's the recipient.
Sure. No, it makes a lot of sense. And
To
that's
most people, their brains just explode at that point.
So I think we kind of went through this a little bit. Why does my capital account decrease? We talked about that, or increase. Yep.
Losses and taking money out.
Yep. Which we do through quarterly distributions typically.
Yep.
Do I receive my initial investment back when the property sells, or the capital account balance? Now I know this isn't a tax question. This is a PPM and operating agreement question. But some, and this is a big, thing that you should look for when you're making a decision on a syndication.
Mm-hmm.
At Spartan, we always return your full capital account or your full initial investment amount back at the end of a syndication. Some PPMs and some operating agreements are written in a way that you do not get your initial investment back. You get your initial investment back less what has been distributed.
Yep.
So it's very, very critical, when you're looking at a deal, when you're evaluating an investment, you say, oh, this operator's, splitting it 50-50, and this one's splitting it 70-30. That's not fair that they're doing 50-50 or they're doing 70-30. Start to peel the layers of the onion back on there, because you really got to look into how, it's an important question to ask the operator. Will I get my full initial investment back plus proceeds on the sale? Or are you taking away are you, kind of following the way the IRS looks at this and saying, well, you've distributed money, so you don't get your full initial investment back. You get whatever is remaining in your capital account. Really key question to ask in the semantics of how a deal is set up, and it's buried in the fine print. So it definitely ask the question and make sure you understand that. I didn't realize that until early this year. I learned that some operators are doing that, so I thought that was a little bit. And come to find out, it's a little bit standard in the industry actually, which is kind of interesting.
Yeah, you
Yeah,
put an investment in, they may not give you back that investment. They just may say, hey, we're going to split up the profit on the property.
that's right.
But again, just because it made money is different than the capital account. So,
Correct.
once people realize that those are two very different things, I could actually make money and I just don't have to pay tax on the return of my capital. Usually you want to get both. You want to say, hey, give me back my money and then also distribute all the profit.
Yes, that's right.
Yeah. Yep.
And it's a completely different semantical thing, because you could say, well, I'm getting a return on my invested capital and it's going to hit 19 or 20% or whatever the projections might be. But that's based on, the initial investment, but you may not be receiving your full initial investment back. And
Mm-hmm.
I think that's pretty interesting. We've never done any syndications that way. We've always just given back your full investment amount plus a return. So
I've seen it.
definitely, yeah, ask the question for sure when you're deciding to do a syndication with somebody. I think I think that couldn't be overstated. So, um, where do I see my capital account reported? We talked about this right at the bottom left-hand side of your K1 is where you're going to get that balance every year. So that's pretty much all the time we have for tonight, but I like to leave, 5 to 10 minutes at the end for questions. So I've got the contact information for Toby and myself on the screen. Do we have any questions tonight? The way to ask the question is essentially go into the go to webinar, and you can type in your question, and we can go ahead and answer anything that anybody has. See, thanks everybody for attending tonight. Let's see, no questions at this point.
They're all sleeping, Ryan.
Yeah, we put them to bed. Yeah, I think people wanted good late night fall asleep material. So talk
No,
about a
they were.
schedule and
It was so thorough. The fact of the matter is usually somebody says, "Hey, you get this K1 and you ask your accountant." That's usually, and then they
yeah,
go, "Oh man," and they ask their accountant and they go, "I don't know what all these numbers mean. What do I owe?" About
exactly.
it.
Make it go away. No, and I think that's the thing of stress. When you invest in a syndication, it's all very passive. So we're pretty much doing the work, which is great. So thank you, Scott. Good stuff, guys. Will this webinar recording be available? Absolutely. Great question. All of our webinars are available if you go to our YouTube channel and type in Spartan Investment Group. You'll find our Spartan Investment Group YouTube channel. We hit 100 subscribers, I think, yesterday. So pretty awesome. I know that's not very many subscribers, but if you do me a favor and hit subscribe, that'll make me feel better about how many subscribers we have. Thanks for doing that. And you can go back in and you can see all of our webinars, to include the one we had with Clint Coons and in previous syndication webinars and things like that.
Yeah.
So Andrew, we got a question from Drew. Hey Toby, you're talking about timing deals every 3 years. Is that so the big year one losses of a new deal will offset the year 3 profits that start coming in? In essence, different syndications offset each other. Can I? Oh, go ahead. Go ahead, Toby. Go ahead and answer that. I
All
have
right.
a real live example of that I'm pretty proud of, that I
Yeah,
wanted
no,
to give.
that's exactly what you're doing. Most
Yeah,
people don't realize they have that much control, and you absolutely do. You're actually looking for, hey, I'm going to have a tax hit this year. How do I offset it? Well, you go find another syndication where you take a big chunk of bonus depreciation. That's what you do. And you don't have to be
yeah.
a real estate professional. You just say, hey, I got all this cash cow. I got the cash cow coming in. You know, the old adage was, if you're paying taxes, you don't own enough real estate. This is that situation.
So Toby, we actually had the flip that I sent you over. We sold and made a nice profit on the flip in the same year we bought this RV park. So
Nice.
all of the income that was earned on the flip was offset by the purchase of the RV park. So
Yep.
Drew, just to nail that even home, yes, the year that you have a gain is the year that you want to buy an asset or buy into an asset that has, especially, the question that you want to ask the operator is, um, bonus depreciation. Are you going to be using bonus depreciation or be doing a cost segregation study? That's kind of the question to ask that if it's a flip, even though you buy it, there's not going to be any depreciation because it's just going to be held as inventory.
Well said, Ryan. This is why, again, here's the thing. This is why you have to do it. If you didn't do it and you didn't see it, it wouldn't be real. It's always like it's this theory. So a lot of accountants and attorneys drift out in the world of theory until they actually do it, and it's important to them. It's not just somebody else's return, it's their own. It's not important enough to really make it real. They're always kind of like, if a syndicator says, well, that's between you and your accountant. Are you doing cost segregation? Oh, that's between you and your accountant. No, it's not. Like, they should be able to answer that question.
Yep. Yeah, and what we always do when we're looking and evaluating an asset, I actually contact my cost segregation guy, Weiss, who sends a estimator out there, and they actually produce an estimate of what the cost segregation will be for what we're purchasing. And I
Hmm.
try to get that into the offering memorandum so that you can see what the estimated losses will be in the first year. And it's really simple to calculate it, because you can say,
Yep.
okay, I'm going to invest $50,000 in this deal, and that gets me 1% ownership interest in the partnership. So then you can look at and you can say, okay, their estimated cost segregation for the first year is $1.5 million of bonus depreciation. So if I take 1% of 1.5 million, That's how I can calculate how much I'm going to lose or having a loss. And then you can go in and say, okay, this is how much gain I'm supposed to have in the first year. And you can say, okay, I'm going to have a $15,000 loss on this investment in the first year because of this bonus depreciation, plus all the other things that they're going to expense to the property.
You
So
know,
that's kind of a way you can sort of plan it,
you know what you
which is
can
fun.
do, Ryan? This is going to trip you out a little bit, and I don't mean to throw this at you. You can do disproportionate allocation of loss.
Interesting.
So if you have people in there with a big tax appetite versus people that don't, you could say, hey, there's certain shares where they get allocated 100% of the loss. Remember, it's lowering their capital account so that, you know, eventually those other people are going to get their capital accounts first, but in the meantime, that loss is being allocated to those individuals who really need it most.
Sure. Well, that's great.
Isn't that a mind warp?
This is why we love real estate.
Uh-huh.
Nothing else is like this.
There
So, which
has
is
to be
great.
economic substance to it. So you do it in the offering. Like if you have people that are like, hey, I have this huge gain and I need some loss. And you're like, okay,
Like,
Class A shares, we're going to allocate the loss 100% to you guys.
yep.
And in the first few years, whatever, and we're going to do a cost seg.
And that's another thing to consider when you're evaluating a partnership. Understand how much of the losses that you share in. It's kind of a weird way of
Hmm.
looking at things, but it's like, people focus on the profit, but focus on what you'll keep and what your losses will be when you're investing in that partnership, and kind of understand that as well. I think that's another key thing to ask.
And
So,
this is where we keep saying it, but that capital account, look at it differently than you do the income or profit and loss from that organization. It lowers your capital account, but the two are not related. Other than that, like the income raises it, the losses lower it, but it's two very different things. What I put in versus what I'm being allocated are two very different things.
sure. Very, very important stuff. Any other question? Oh, here we go. Doug, thanks for asking a question. Can I offset dividends and interest income with these losses? How about capital gain distributions from mutual funds?
Yeah, don't you wish? So there's actually three types of income. So now you guys are all going to be accountants because I tell you, most don't realize there's portfolio income, there's passive income, and active income. Portfolio income is your interest, dividends, capital gains, royalties. Your passive income is just rents and businesses in which you don't materially participate. So the answer to your question is probably not. You're not going to be able to offset any of those types of income with these losses. This is passive activity losses. They're just going to offset each other unless you have a passive investment like in an S corp where it's just kicking out income. It has to be the actual profit that's coming through. And then if you have real estate losses, it could offset that because they're both considered passive. Otherwise, no. And against a dividend, no. But here's, since you brought up capital gains, you should understand this. Long-term capital loss offsets short-term capital gains, which is what you never like. That's a good situation where something that's not worth a lot to me is offsetting something that I'd be taxed at my ordinary rate. And on the same token, short-term capital loss offsets long-term capital gains. So you don't want to be in a situation where something that carries a really low tax bracket, like long-term capital gains capped at 20, is being offset with a loss. That's an ordinary loss. So it's much better to do the reverse. Some of you guys may be going on a cred and just right over your head type stuff, but just know that you're accountant and you should be having a little conversation, and you want to make sure that, hey, if I have some losers that are going to offset short-term gain, which is taxed as ordinary, like if you could be that if I have some property, I wouldn't say it would be property. Let's say I sold a property that I didn't intend to sell. I didn't mean it to be a flipper. I just bought it and then I sold it and it was short term. Well, if I have any losers out there, I could offset that short term gain with my long term loss. So just be cognizant of those and maybe be looking at it. Usually it's in the stock market that you're looking at these things. You have companies that have run up companies that have lost a little. And most accountants are familiar with the wash sale rule, where they say if I sell something at a loss and buy it right back, that it treats it as though I didn't sell it. There's no such thing for winners. So if you sell something at a gain to offset something that came in at a loss, all I do is I buy it right back and I readjust my basis. It's probably not something you want to talk about on a real estate webinar, but for those of you guys who are investors, just know that that works great. If I have some loss on something, I might want to sell some winners just so I can adjust my basis upward and
Sure.
use up that loss in the future.
Yeah, and I think that's what we do. That's why every year, what I do for our CPA firm is I prepare kind of a note to tax preparer, and
Yep.
I say something like to my CPA, this partnership was formed for the purpose of buying and selling real estate as inventory. We expect all the units to sell in this tax year,
Mhm.
and we have 10 investors in this deal, and it's expected to pay out this much. That way, if you kind of write down everything that you want your CPA to know about you holistically, I think that really helps so that when your CPA is reading it, they can understand, okay, okay, you own part of this RV park interest. Okay, that's a 5-year hold with the eventual sale, and you're making about 17% distributions or whatever it is. But you're also in this other partnership where they're buying and selling property that's going to sell in this year, and you also have this. So I think it really just helps, like your CPA being in the loop on everything that's going on in your life, so that you can make better strategic decisions on what to buy, what to sell. When you're deciding between, like we have 3 solicitations going on, in our deals right now. So which ones do you invest with, and how do you invest in them? Do you do an IRA? Do you do a 401k? Do you do cash? And then, if all things being equal, what deal makes the most sense strategically for my risk tolerance and for my tax purposes? And that can really, you can really start getting strategic in how you set these things up, and really get the most bang for your bucks on the tax side of things. So anyway, it's kind of a long answer, but good question, Doug.
Brian, it's not what you make, it's what you get to keep. And at the end of
That's
the
right.
day, that's what it boils down to, is if I can shave some off of my tax bill, that's our biggest expense, more than our food and shelter and clothing combined is the average American's tax bill. So if we can push that down a little bit, usually it goes a long ways.
Absolutely. Toby, thank you so much for your time tonight. I appreciate all the good knowledge dropped. Ready
It's
to fire
fun.
my I'm ready to fire my CPA now and take my exam and be my own accountant. So
Yeah, I tell you what, they work for you. And all joking aside, I always say the CPA works for you, not the other way around. And some of them start thinking that somehow that you're beholden to them, and it's no, 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 no. So the more you know to help guide them and make sure that they're not hosing you, the better.
no, Hunt Jackson does a great job. Appreciate that.
Yeah,
So all right, well, thank you so much for joining us tonight. If you guys have any questions, our contact information is up on the screen there. Feel free to reach out. And this webinar will be recorded and posted up to our YouTube channel for future viewing. So thanks everybody for joining us this evening, and have a great night.
thanks, Ryan.
Thanks.